Hey guys, Freaky Finance here. Last week we looked at Madison Square Gardens Networks, a company that did advertising for the Knicks and for the Rangers. They make money on that. Today is February 27th, 2021, so keep note that the last week of February was pretty rough for a lot of securities, specifically in the tech sector. Alright, so anyway, today we're going to talk about DHT. So this is an oil tanker play, and this was a lot of fun. Someone asked me to do an oil tanker, so I went through 4 and I picked this one. Just to me, this one looks, I guess, the best, but they all look really cheap. But that's backwards looking, so we'll get into it. Basically, DHT has a fleet. I think they have between 27 to 29. I think just added 2 in January 2021. MVLCCs. A fair amount of ships. I'm going to bring this up. So that's just, they're under contract at a certain rate. And importantly, you can see the bottom ones here are all under contract still, because these ones are getting older, right? Average life for a tanker, we'd say 20 years before they're gone for sure. And before that, they have the option to scrap, right? If the economics are bad and the salvage value is high, they might just axe it. Anyway, a pretty good fleet, and some more current. Quite a bit are fairly current. Some are getting old. And that's true in the whole industry. Is actually, it's one of the reasons why it looks good. Because tankers are really, I mean, every tanker thinks they're special, but really it's a commodity play. And the ships themselves are the commodity. So it's like, and you might think, well, oil's the commodity, and you're right, but it's kind of like there's 2. And the tankers themselves are also a supply and demand factor. Just wanted to point this out. When you look at it, we're about to jump into the numbers, but when you look at it, 2020 was really good. And one of the reasons why, well, we're going to find out in a second, is because Q1 and Q2 of 2020 was a phenomenal year for the shippers. So they screen really well. And that's probably why someone asked me to look at it, because the PE is very cheap, backwards looking. When we jump into the numbers, you can see right off the bat, revenue's up quite a bit this annual for DHT Holdings, ticker DHT. Anyway, you can see revenue shoot up 160 million. Importantly, you also see COGS go down 40 million. So you have a $200 million increase in GMD. And that's a material increase, right? All the other numbers are fairly flat. Depreciation is the next biggest cost item, and that's non-cash anyway, because your fleet basically depreciates over time, just like a car would. GA did increase 3 million. Again, I just flag it because I'm picky and I want to see scale. And really, you do see scale. You see scale right here, right? They increased their revenue, but COGS didn't go up with it. That's pretty good scale. And really, that's a function of the spot rate. So it's not something the company can really control. They can kind of mitigate it with contracts. On the whole, really, it's a function of spot rates. And spot rates are a function of the demand for tankers. And the demand for tankers is really dependent on the production of oil. And the production of oil can be dependent on the oil price, and it can be dependent on OPEC releasing more production, right? And those things are often correlated. As price slowly increases, supply should increase to meet it. So it's kind of cool. And these cycles are really long for shippers. This makes this idea very interesting, and I can see why someone's looking at it right now. Interest expense, really good. Decreased 16 million on a $54 million number. Quite a bit, and honestly, those numbers are very small relative to their GMD and depreciation. So whatever their GMD nets up is going to be is really the net up in net income. So basically, the spot rates flow through to the bottom line, the increases. So it just really is like a levered play on spot rates for tankers. And you can see that increase is dramatic, right? You're going from 73 million on the bottom line to 266 million. However, when you look at it, you can see the share price. This is at December 31st, 2019. You can see it actually got cheaper on better numbers, and so it looks really cheap. But you got to remember that Q1 and Q2 in 2020 were outliers, mainly because producers of oil were still producing and the demand got shut off from COVID. So you had all this production that was already done that needed to go somewhere, and so a lot of companies decided to put them on tanker ships, and so the tankers got paid to sit and hold the oil. And then they also made extra money because you had to keep relocating the oil because they weren't sure where the oil needed to go at certain times because the demand was so screwed. So they made more money because they had to go on less efficient trips, less efficient for the oil producers or the people that needed oil, but more efficient in terms of the tanker because they make money on the distance traveled. So it was kind of a really unique situation, and the spot rates show that. I'll show you that in a second, but it's awesome for this type of company. DHT, so one of the reasons why I picked them is because they decided to pay down debt with the extra cash windfall from Q1 and Q2 2020. So I like that. So not only is the company cheaper in terms of equity market cap for about 400 million, you're also cheaper in terms of debt So your total, so really if you're doing EV, that you never usually talk about, but really just your equity market cap, and then you add the total indebtedness. So you do that. So at the end of 2019, you were sitting at about $2.1 billion valuation for the company. And currently, you're sitting at a $1.4 billion valuation for the company. So you're getting this, it looks like it's only $400 million cheaper on equity, but it's also $400 million cheaper on total indebtedness. So you're picking up something that's close to getting $800 million cheaper. So you're almost getting this price 33% cheaper than what you were headed last year. So very cool. They do have an accumulated deficit, but it's starting to go down because positive retained earnings. So when you look at it, it's a hard business to make money, I guess is what I'd say. However, there's certain times where it's very easy to make money, but really it's a function of the spot rate. And I'm going to see that probably more than enough times this video. I'm trying to go fairly fast here because I got a lot of slides. There's a lot of good information. CFO against spikes. So not only do you have the better GMD, but depreciation is a large part of that. So you add that back. There was for cash terms, there was a favorable AR swing, but for asset terms, negative because AR went down because Q4 2020 was not good. When spot rates are lower, your revenue is going to be lower and your AR is going to be lower. So there's a big swing here up to the upside. So really, you should take that back. So the real swing is about 220 million more, and that correlates with the extra GMD roughly. It all works through, and it's a very simple business model. So it's actually really nice for me. So I did want to find out why GA was higher, and I could see on their cash flow statement that share-based comp was higher. So they paid themselves an extra $3 million, and that showed up here on this G&A line. So the only thing I can fault them for, because the metrics look really good, and that's probably why someone's asking me to do this video, dividends paid, you can see shoot up from 28 million to 214 million. So they paid down their debt, and they decided to give quite a lot of cash flow to shareholders. And since I'm not a shareholder during 2020, I think that's bad, because I would prefer that they either bought back their shares because their shares are so cheap right now, or they just kept it on the sheet and the net debt went even lower, right? Kept it on the balance sheet. So anyway, the metrics check out mainly because of the function of the higher spot rates during 2020, specifically in Q1 and Q2. PE, so I had to double check on that, but that actually checks out. It's super cheap because it's on 2020 numbers. And 2020 numbers had that outlier in Q1, Q2. Importantly, they did pay down their debt though, so I like that. So again, I don't like that they paid a dividend given the cyclical nature of the business. Why not buy back shares now while they're cheap, right before the upswing that they're anticipating? Economics are there. This is just notes to myself because I don't own this company, so I'm trying to think about when I should make an entry, whether it's now, whether it's 4 months from now, 3 months from now, because Q1 doesn't look great for these oil tankers because the spot rates again are kind of low, but you have oil price starting to tick up, and you might see a production response, right? I mean, a lot of the oil companies that I've been looking at aren't increasing their production. Whatever they cut during COVID, they're going to cut. And then OPEC, though, should probably start thinking about increasing production at some point, and that would be good for these guys. And what I'm thinking is because this company kind of has, or these tankers kind of have a correlation to the oil prices. That's not necessarily true. We see that they have come up with the oil price lately. But what could happen is when they do this production increase, OPEC does, these securities might, in error, sell off with the oil and gas sector, right? If prices come down. So that could be my entry, because really this company or tankers make money on the production side. The more production, then they need their tankers to move the supply of oil. That might be my either a real entry, or because I might just do a small entry after this next week sometime. But that looks very interesting. Anyway, I was kind of running around a little bit, but that's how my brain kind of works through ways to try to get into here, because as I'm going to talk about, there's a real cycle here. So quarterly, I'm just going to go this really quick, see how Q1 and Q2 2020 were amazing versus Q4 swings down. And then in terms of net income, you can see this go from 72 million quarter, 135 million in Q2, 40 million in Q3, down to 7 million. So very, very contingent on the spot rate. And you can see spot time charter equivalent per day. You're going from, you average 62 or 59. See, you're going from 63, 65. Q2, you're going to 87. And without the IFRS 15 adjustment, you're at 92. And then you can see it get halved during Q3, and then you can see it get halved again in Q4. So this thing is very volatile, and you see that in the numbers right here. And I think the market's trying to discount both at once. Like they're thinking Right now, Q1 is going to be weak and Q2 is going to be weak, but they might not be anticipating something more normal like Q1, right? That's 66, which is nice as well, right? Even 59. This is not DHT's slide, this is Euronav, but they have some pretty good images that I'm going to borrow from. So I kind of talked about the demand for oil. Ultimately, demand for oil increases the price, and then you get a supply response. And the supply response is what drives these guys' spot rates, because they're going to need a place for the oil and to ship more of it around the world. So supply of oil hasn't yet responded, but the price of oil has, right? We're starting to see that in WTI over 60. So what could happen and what may happen is that they might start unrestricting some barrels, especially as we get vaccines and jet fuel comes back. So that could be a good thing in the future. Right now they gave it a red light, but I view that as, well, it's going to, in the future, it's going to be a green light. Ton miles, so distance traveled. That's how they get paid. So the long ship routes, say from the Gulf of Mexico and States to China, is a very long route, right? And you get a lot of money per day by shipping it. Vessel supply, so that's we'll talk about that in a second. Order book has a percent of fleet's 25-year lows, so I'm just trying to show how cyclical this is. So you can see, well, really here 2022 or 2002. You can see order book percent of fleets fairly low, and then whoa, they chased the cyclical move from 2002 to 2008. Energy really took off, and so did tankers, and so order books increased dramatically. And then you had the bust because they overcompensated. It's the cyclical nature of the industry, but you can see we're back down to here. That doesn't necessarily mean we're going up immediately, so that's what I'm trying to think. But it does generally support a higher spot rate as we move through. So this might actually be the lull period of a very big cycle. Could be another, who knows, could be another 8-year move or something, right? So this kind of reinforces each other. Order books low, money coming in is also low. So no one wants to touch, kind of like what I talked about with the Suncor video. No one really wants to touch energy companies because it's like where dreams go to die, I guess. I don't know, but no one wants to touch them. So it makes there's some opportunities there because less people are looking there. So anyway, for tankers, similar idea. Not a lot of money coming in to the industry. And they're not even tapping, like there's no billions raised for shipping IPOs. It's not a good time to start entering the business. Well, usually these things lag. They don't get in until it starts looking better, right? And again, that takes time to work through. Vessel supply, again, looks very bullish. Not only that, you have new technology. You're going to have these environmental caps. So you have to make sure that your ships are good enough for these regulations. And the thing is, some of these regulations are changing as we speak. So why would you put capital to work when you don't know what the regulations are going to be? I mean, especially if a tanker is 20-year life cycle, you want to make sure that those 20 years you're going to be yielding income, right? You don't want 10 years of income because they decide to change the regulations 10 years from now, right? All of a sudden they demand everything on LNG for all these tankers. I don't know. So it's that's one issue for new supply. So that actually supports the current supply. Order book, you can see we already talked about that, very at 20-year lows, 25-year lows. So very, very favorable order book. No one's putting money to work. An operational fleet. So this is an interesting fact. 21% of the fleet needs a special survey by the end of Q1 2021, which is one month from now. I did want to bring out subsequent event. They did put some, because I just went through the annuals for 2020, but first month of 2021 they actually bought 2 more VLCCs, and usually that's a sign that they're expecting future increases in the spot prices, and they probably got them what they view near or nearing the low of the cycle. Right, this is back to DHTs. So this is the one thing I don't like I kind of harped on that already. Like, obviously if you're a shareholder, you literally made $1.35 in dividends in 2020 because they paid so much, right? And versus the 2019 year when they only paid you 20 cents. They literally gave you 5x the dividend. Oh, yeah, actually almost 7x the dividend, which is pretty crazy. But from my perspective, looking in, because I'm not a current shareholder, I didn't get any of this, right? So I'm like, oh, Rick, you should have just bought back your shares because they're so cheap, traded at 4 times earnings. But that's just me. And again, that's kind of hindsight, but that's what I would have done. Or at least I kept it on the balance sheet, and your debt looks even better. Anyway, so I already talked about aging fleet, but this chart from Euronav looks really good, right? You can see just how old this fleet is getting, right? He hasn't seen this since 2022 or 2002, so that's 19 years ago. So we're starting to see again a cycle, and this kind of also shows a story of the boom during 2002 to 2008, right? You can see the average age actually slowly go up, and then everyone's chasing the money and superior economics, 2008, and you can see the average fleet actually go down to 7.5 years. And then you can see after, really 2011 was a peak for a lot of commodities. Oil's one, but then they also had a boom in 2016, and you can see them chase it again. The main thing is the long cycle. You can see that, generally speaking, when the age gets that old, you're going to start looking pretty on the spot side, the spot rate side. So DHT is actually interesting for the Q1 2021. They actually have 58% fixed for coverage. So they've been booked at an average rate of 34,700, which is above the spot rate currently in Q1. So they're looking fairly good during Q1 relative to their competitors. So they smartly hedged some of their book during the strength of the first part of the year. So I like that about the management team then. So I can dock them for the dividends, but I can praise them for this debt reduction. I can praise them for this, locking in some good rates because they're anticipating a lull. So therefore Q1 won't be amazing, but it's not going to be complete crap. And then, but Q2 could be, right? So that's what I'm trying to wrestle in my head. Do I enter after Q2 bad results, or is that too late because the supply is starting to pick up because the world's opening back, right? So it's hard in my head. So anyway, here's just another way to show what they did. So spot exposure, you can see they were running on average a pretty high spot book, 83% on average in 2019. You can see in Q1 it was 84 spot exposure. They started capping some contracts because the rates were so high, so very smart. And you can see Q4 spot exposures only 40%, so they locked in some pretty good rates above market because the market, obviously, Q2 was hyped up, and Q3 and Q4 have been weak, and Q1 continues to be weak, and Q2, who knows, but it could be weak. It's very interesting to see this, and you can see the spot rate per day, just how volatile it is, right? Going from 92 to 19. So very cool year to look at for 2020. The cash break even for DHT. So this is another way to view just how, so the bar chart is the average VLCC spot earnings. And you can see just how volatile it is, right? You're going 41, 53, 15, 17 for the entire year. You can see during 2008, this is when a lot of money came in and a lot of shipbuilding happened, over shipbuilding. Really, it probably started here, and then overbuilding led to this, right? And obviously you had the great financial crisis too. So DHT, as far as they're concerned, this is from their perspective, they're basically saying they acquire VLCs when, right after the boom, right? So 2016 you had a decent boom, overbuilding, they acquire them on the cheap when rates are low, and then they see a boom, they clean up the balance sheet, lock in some good contracts, right? And then they acquire again. That's what they just did in 2021. So basically they're saying they're managing the cycle as well, and I think they have, but I would have still preferred no dividends. But I'm picky. They also cleaned up their capital structure, so they decided to redeem their convertible notes, and then the converts just said, nah, we're gonna just run and take the shares then. And the converts got in at 5.34, so that could be an interesting place to play right that way. You get in where the converts got in during August. So from TKs, you can see the charter rates just in Q4 2020 and Q1 2021 aren't very good. Now this is TKs, so they're just saying we have a better rate than the spot rate because they have contracts. And so does DHT. So they're all trying to do good things, but I think DHT, this is the other company I was thinking about. TK had also screened very well, and they also paid down their debt. These companies are fairly similar. This slide I thought was really good. Well, the source here is the EIA, but you can see that they're starting to expect supply to start moving up, right? Because demand's kind of already started, and we start seeing that in the price, right, with WTI at 60. So you might see a supply response, which is actually bullish for tankers because they actually make money on moving the supply, and the demand is a function because the supply reacts to the price of oil. And the price of oil reacts to the demand. If this is true, this should be bullish for tankers. And then you have the tanker fleet growth in general. You can see that it's not growing anymore. And they have some scrapping going on. We'll have to see. They're basically expecting not a lot of ships to enter the market. So this one, I'm not sure if you guys can see. It's a little bit smaller. This is on the EIA website as well. And you can just see, I just bring up jet fuel here. This is this brown line, million barrels per day. You can see falling from an average of 4.3 million barrels per day in January to 1 in April, less than 1 in May. So jet fuel hasn't really come back. This ends in July, so this is kind of outdated. But you can see jet fuel that's a delta of 3 barrels per day, right? So we're going to get that extra demand uptick eventually. I mean, people are already starting to book trips, so we're starting to see that in the numbers. So anyway, these jet fuel consumption should start increasing, which again will likely lead to a supply response, either from OPEC or just from general producer oil. Very interesting time to see how this plays out. Again, what could happen, or would be interesting to me, is if there's a supply response, oil tanks, like the share price of oil companies tank, and it pulls down the tankers with them. That would be exciting for me, because it's a time when supply is actually increasing. And that's how tankers get paid. So it would look to me like an attractive time to get in. DHT, I just went through their transcript before I jumped on, but they do have basically they're saying the reason why they held on to some of their older ships, like those 2004 ships I told you about, is because they're able to lock in some pretty good contracts, and the values of their older ships didn't appreciate as much as the underlying opportunities for earning. So basically, when I showed you this fleet and you saw these 2004s, they are contracted out until the end of, well, 1 more month from now. But basically, they're able to still use them, so I scrap them yet if the current values are too low relative to what they're able to earn. So again, I view that as prudent management, but they do say if they do hit 20 years, they will definitely go. So that's a quote, and that's kind of in the industry. When they hit 20, they're gone. And the share price. So this is a very interesting stock chart, but you can see topped out in 2016 in the $8 range. Let's just say it did actually peak up pretty close to 9 there. Anyway, let's just say the $7 to $8 range, and then during the lull of energy, you see 2017, 2018, this thing's actually very down to $3.50 a share. So it started to pick up in 2019, especially in the back half. And then you had the COVID spike and the response going up to $7 a share. Now we're back down to 5.6. Now one of the things when you look at the stock chart, you got to remember how the balance sheet changed as well, right? So back here they had $400 million more in debt at least, so you get a better balance sheet at a fairly attractive time. So it's an interesting time to start thinking about getting into the tanking industry. Hence the reason for the video, and probably the reason why someone's asking me about it. I do want to point out here, if I go farther back, you can just see, well, this is also very telling of the time. So like I said, 2002 to 2008, very cyclical boom for energy. And you can see, just even this company, IPOs during a cyclical boom. How many IPOs have we seen lately for tankers? Right? So this is very telling of when a boom is happening and everyone's chasing the money. And then 2011 was the last part of the recovery from 2008, right? This company's had a rough run in terms of share price, but again, that's probably a function of the share count. They're probably financing some of these ships with issuing shares, right? So, but yeah, you can see just how volatile the stock is. It doesn't take much for this company. If spot rates increase again, they get back in the 7-8 easy, right? And then if it actually is a long cyclical move, this could be pretty interesting because they're shoring up their balance sheet with the extra cash. So all in all, pretty interesting company. I'd like to know your thoughts on the tanker industry. It's slightly different than everything else we've looked at. Like I said, it's kind of like almost like a commodity play on a commodity play. That's kind of how I view it. But yeah, I'd like to know your thoughts on DHT, and have a great rest of your weekend.